In less than 48 hours, silver did something that breaks the way most people think markets work. 60. That isn't a mild correction. That's a shockwave. Through every contract that assumed yesterday's price would still exist tomorrow, through every factory that budgets input costs months ahead, and through every risk model calibrated to calmer moves. They said modern liquidity made swings like this unlikely. They said the market was too deep, too hedged, too efficient to produce air pockets where bids vanish and price drops through levels like they were never there. And yet, it happened anyway, not over months, not over weeks, but compressed into a handful of sessions. What's most unsettling is not that silver fell, it's that the people who are supposed to be frightened by falling prices didn't behave frightened at all. Under the surface, the behavior looked like urgency. Because here's the part most people miss. In a stressed precious metals market, the price you see is only a headline. The real story is a tug of war between two versions of silver that pretend to be the same thing. One version is financial silver, shares, futures, swaps, and promises that can be created in seconds. The other version is physical silver, bars and coins that must be refined, assayed, transported, stored, and delivered on the schedule of the real world. Most of the time, those two versions track each other closely enough that nobody notices the seam. In stress, the seam opens, and the gap becomes the story. And that is what cornering looks like in the modern era. It doesn't arrive with a single dramatic announcement. It arrives as a pileup of rational decisions that, together, force an irrational outcome. It arrives when too many claims point to the same finite pool at the exact moment that pool is least able to move. It arrives when institutions quietly compete for access, while the public argues about charts and headlines. Welcome to Signal and Structure, where we decode what matters before it becomes tomorrow's explanation. If you've ever felt like markets move first and stories follow later, you're not imagining it. The story is often visible in the plumbing, in vault data, in fund flows, in leasing stress, and in the rule changes that decide who can keep holding risk when volatility explodes. If that's the kind of clarity you want more of, stay close. And tell me in the comments where you're watching from, because these pressure points look different depending on where you live and what you can access. Now let's reconstruct what happened with dates and numbers, because this only makes sense when you treat it like a case file. 64 print, a level that would have sounded extreme to many silver watchers not long ago. Then the market experienced a violent downdraft. Reports describe silver falling from about 121 to as low as 64 before rebounding. On January 30th, silver dropped roughly 27% in a single session. That kind of move is the sort of thing that normally empties the room. People back away. Positions get reduced. Liquidity providers widen spreads. Everyone suddenly pretends they were never interested. But the flows told a different story. On that same January 30th session, more than $100 million went into the iShares Silver Trust, ticker SLV. Over the 6 trading days ending February 6th, nearly $430 million flowed into that one vehicle. $8 million into silver-linked ETFs over the prior month. And one dataset described SLV as experiencing 169 consecutive days of positive inflows. In other words, what looked like panic on the chart looked like accumulation in the plumbing. That is the central mystery. Why would capital rush toward an asset during a crash big enough to trigger forced selling? The simplest answer is that different participants were solving different problems. Some were reacting emotionally to price, others were responding mechanically to availability and settlement. To see the difference, you have to understand how silver's modern market structure works. The financial side is massive. Futures contracts represent large amounts of silver with only a fraction of the full value posted as margin. ETFs allow exposure through a brokerage account without handling a single bar. Unallocated accounts and derivatives can offer synthetic exposure with minimal friction. This is the fast lane. It is built for convenience, speed, and scale. The physical side is slower and more rigid. Deliverable bars have defined standards. Vaulting and custody involve chains of responsibility. Fabrication capacity can become a bottleneck even when raw metal exists, because turning raw metal into a specific bar or coin is a separate industrial process. Transportation has constraints. Insurance has constraints. Even paperwork has constraints. In normal times, arbitrage keeps these worlds aligned, and the difference feels invisible. In stress, the seam opens. When the seam opens, you often see two contradictions. The first is price volatility that looks detached from the tidy supply and demand stories people prefer. Total stock is what exists in vaults. Available stock is what can actually move right now to satisfy the next urgent claim in the required form under the required rules. That second number is the one that matters when a market is under pressure. This is not the first time silver has hinted at this split. In 1980, silver became the epicenter of a historic squeeze, with concentrated demand colliding with limited deliverable supply and the market's risk managers responding with rule changes that accelerated a reversal. The details of that era are unique, but the structure is familiar. Concentrated pressure meets constraints, and then the rules change. In 2011, silver surged and then reversed sharply as leverage met shifting conditions. Again, the structure repeats, momentum builds, collateral costs rise, and the exit becomes narrower than the entrance. The playbook across decades is not that silver always rises. The playbook is that when the market's promise layer expands faster than the market's delivery layer, stress accumulates. And when stress is released, it tends to be released through volatility, rule changes, and a repricing of what immediacy costs. Now fast forward to early 2026 and focus on a piece of data that sounds like it should end the shortage conversation immediately. London Vault Holdings. At the end of January 2026, London Vaults reported holding 27,729 tons of silver, valued around $92 billion, equivalent to roughly 924,304 bars. That is an enormous stock. But big numbers can hide small truths. A vault total is not the same as a free float. Metal can be present and still be unavailable to settle the next claim at the next moment. Some of that metal is already spoken for, tied to financing structures, long-term allocations, industrial chains, or custody arrangements that make it legally and operationally sticky. Some may be in a form that is not immediately deliverable into the channels where pressure is building. Some is held by actors who have no interest in selling at the posted price, because the posted price is not the price they would accept to part with metal they view as strategic inventory. The market can print a headline price, but it cannot force willingness. This is where institutional behavior becomes the signal. Start with the exchanges and clearinghouses. In a volatility event, their job is to keep the system from breaking. They do that by adjusting margin requirements and risk parameters. When margins rise, anyone using leverage has to either post more collateral or reduce exposure. That's not a narrative. That's a mechanical trigger. Mechanical triggers create cascades. They can push paper prices down even as physical demand remains firm, because the forced action is happening in the promise layer. Then look at the big funds and the machinery around them. When an ETF like SLV experiences heavy inflows, the structure can require the creation of new shares, which is typically connected to sourcing and holding metal through custodial channels. Authorized participants and custodians interface with the physical market in a way most investors never see. When inflows are persistent, that machinery can become a consistent pull on specific pools of deliverable metal. When inflows arrive in bursts during stress, they can feel like a vacuum at the margin. Now add bullion banks and dealers, the intermediaries that provide liquidity and manage inventories. One of the clearest stress signals in precious metals is what it costs to borrow metal short term. Tight leasing conditions tell you something simple. Metal is not freely available at the margin. Someone is paying up for immediacy. Someone is worried about being short access, not just a short price. And that kind of worry spreads because intermediaries hedge their own risk by reducing exposure when conditions tighten. Finally, include industrial users, because silver is not just a financial object. It is embedded in electronics, solar components, and high conductivity applications, where substitutes can be costly or impractical. Industrial demand does not usually chase price in the same way speculative demand does. It is driven by production schedules and delivery deadlines. A manufacturer can sometimes delay a purchase, but it cannot delay shipment indefinitely without consequences. In a stressed environment, industrial users may prioritize securing supply even if price is unpleasant because downtime is worse. When you combine these players, you get a picture that looks less like a simple bull market and more like a contested supply chain. Price becomes less an opinion and more a rationing mechanism. Now we reach the dislocation, and this is where the argument that nothing is happening collapses under its own weight. On one side, you have the apparent calm of scale, a vast financial market with constant trading, a large reported vault stock, in the sense that any demand can be met because markets exist to match buyers and sellers. On the other side, you have the behavior of participants who do not behave calmly. Hundreds of millions of dollars rushing into the largest silver ETF in a matter of days, including a surge on the very day the price fell 27%. That is not how a relaxed, well-supplied market behaves. That is how a market behaves when participants believe the screen price is temporarily disconnected from what matters. This is the part most people don't want to consider. A market can be liquid in price discovery and illiquid in delivery at the same time. You can have enormous volume on screens while the metal that anchors the ecosystem is effectively sticky. If too many participants choose to hold claims that reference deliverable supply, and too few participants are willing or able to part with deliverable supply on demand, the system doesn't gently negotiate. It forces a repricing of time and availability. Think of it like an airport. The departure board can show hundreds of flights. Tickets can be sold instantly. But if there is a constraint on physical gates, runway slots, crew availability, or weather windows, the schedule becomes fiction. People can still trade tickets, The market can still quote prices, but the ability to actually depart becomes the scarce asset, and scarcity expresses itself through delays, surcharges, and prioritization. In precious metals, departure is delivery, and scarcity expresses itself through premiums, spreads, and sudden rule tightening. This is why the London Vault number is both reassuring and misleading. 27,729 tons is a mountain, but if only a fraction is available for immediate settlement into the specific channels where claims are pressing, the effective supply that matters for a squeeze is not the mountain. It is the stream coming out of the mountain, and whether that stream is already committed. One more layer makes the plenty of metal argument easy to misread. Classification. In major futures hubs, warehouse stocks are divided into buckets that sound similar but behave differently. Metal can be eligible, meaning it meets a specification, while only a portion is registered, meaning it is actually tagged and ready for delivery under exchange rules. The labels differ across venues, but the principle is constant. A headline inventory total can include bars that are perfectly good, yet not offered for delivery because their owners have other plans: collateral, long-term storage, or strategic inventory. That is why a market can show a large total and still feel tight at the margin. A similar split exists in account structures. An unallocated balance can represent a claim on a pool rather than a specific bar. That works smoothly until many holders want allocation at the same time. Allocated metal requires bar selection, serial documentation, and custody changes, and those processes compete with real-world throughput. When stress rises, the system exposes a blunt truth. What matters is not only how much exists, but how much can be mobilized quickly without forcing a chain reaction in financing, hedging, and inventory policy. You can also see tension in the curve and in settlement behavior. When near-dated demand intensifies, spreads can behave oddly, and more trades get pushed into private settlement mechanisms instead of standard delivery. Those signals say the market is paying for time, not just simply ounces. Now, let's make the evidence concrete, because abstraction is where confusion hides. First, the price action itself is evidence. 60 by February 9th, 2026 is not random noise. It is a signature of stress. Markets under stress overshoot, they gap, they create forced trades, they move like a crowded room trying to exit through one door. Second, the flow behavior is evidence. Nearly $430 million into SLV over 6 trading days, ending February 6th, with more than $100 million on January 30th during a 27% drop, indicates that demand was not purely timid or passive. It indicates participants were using weakness to accumulate exposure and size. Whether those participants were retail trend followers, macro hedgers, or intermediaries adjusting inventories, the structural effect was the same. Pressure increased on the conduits that connect paper claims to physical custody. Third, the persistence is evidence. $8 million of retail spending into silver-linked ETFs over the prior month, and the notion of 169 straight days of SLV inflows suggests a sustained trend of demand through the same pipes. Sustained demand through a narrow pipe matters more than occasional bursts because it steadily removes slack. Slack is what prevents corners. Slack is what absorbs shocks. When slack disappears, small events become big. Fourth, the physical base is evidence because it provides scale and limitation simultaneously. London's end of January 2026 figure of 27,129 tons, valued around $92 billion and equating to roughly 924,304 bars, shows the system's capacity. But the direction of change, a monthly decline, shows movement away from excess. A tiny leak in a dam does not matter until it reveals the dam is under pressure. In markets, direction matters as much as size. So how does a modern cornering dynamic actually execute step by step, without anyone needing to coordinate in a smoky room? It begins with a shared assumption. Not everyone will demand delivery. The promise layer relies on netting. It relies on the idea that most participants will close positions financially rather than ask for metal. That assumption is usually safe. Then a narrative shifts, or macro conditions shift, and more participants decide to hold exposure longer, or to express exposure through vehicles that are closer to physical settlement. ETFs, certain futures strategies, and inventory-based hedges can increase the number of claims that lean on deliverable supply. At the same time, metal becomes less mobile. It gets tied up in industrial buffers, long-term holdings, collateral structures, and the normal human instinct to hold onto strategic inputs when uncertainty rises. Intermediaries may reduce lending when funding conditions change. Dealers may widen spreads when volatility rises. Refiners and fabricators may hit capacity limits when orders surge. None of this requires a conspiracy. It requires only a system with finite throughput. Then volatility arrives, and the system reaches for its safety levers. Margin requirements can rise, risk limits can tighten, leverage becomes expensive. Participants who were comfortable in calm conditions find themselves forced to reduce exposure quickly to meet collateral needs. That forced selling happens in paper first because paper is what can be sold instantly. The screen price drops, sometimes violently, even as the underlying demand for secured exposure remains. That is how you can get a day like January 30th. A dramatic drop on the screen alongside a dramatic surge into the vehicle most people use to hold silver exposure. This is the mechanism that confuses people. They assume price tells the whole truth, but price can be moved by forced transactions that have nothing to do with long-term fundamentals. Meanwhile, the participants who care about access read the drop as a moment to secure exposure before the pipes tighten further. That creates a feedback loop. Volatility triggers forced selling triggers bargain buying pressures. The physical linked conduits. Physical linked pressure increases borrowing stress, and borrowing stress encourages intermediaries to reduce risk further. And eventually, something does change the incentives because the gap cannot persist forever. Now comes the forward analysis, and this is where people usually demand a forecast. But the more useful approach is to ask what this pattern has led to historically when it appears. Historically, when you see violent volatility paired with persistent inflows, and when you see physical signals and paper signals diverge, the market tends to resolve through one of three pathways. In a conservative resolution, spreads widen, volatility remains elevated, and leverage is gradually flushed out, reducing paper claims until the system can breathe again. In a moderate resolution, physical premiums and financing costs rise relative to spot, meaning the headline price becomes less representative of real procurement costs. In a more aggressive resolution, the market experiences a sharper repricing and tighter rule enforcement, pushing risk out of weak hands quickly and forcing a new equilibrium between promises and deliverability. None of these outcomes requires certainty about direction. They require recognition of stress. The market is telling you that immediacy has become valuable. The more valuable immediacy becomes, the more likely the system is to impose costs on those who rely on frictionless promises. So what would confirm that the stress is continuing rather than fading? Watch whether ETF flows remain positive after volatility spikes. Watch whether vault totals decline persistently, especially if declines accelerate over multiple months. Watch for continued discussion of tight leasing conditions because that is a direct window into short-term availability. And watch for exchange or clearinghouse adjustments that effectively discourage certain kinds of positions, because those are the levers the system uses to protect itself when too many claims press on too little deliverable supply. Now the choice ahead becomes clear, and it is not about being brave or fearful. It is about where you look. Most people look at the last price on a screen and assume that number is reality. It is a data point, but it is not the entire market. The market is also flows, inventories, financing, and settlement terms. Those mechanics move first, narratives catch up later. And when a cornering dynamic is in motion, the difference between early and late is not a philosophical debate. It is the difference between understanding what is happening and being surprised by it. It is a story of a system wrestling with the relationship between claims and deliverability. It is a story of a market discovering what convenience costs when everyone wants it at once. It is a story of institutions responding to constraints in the only language markets truly speak: collateral, inventory, and rules. This is signal and structure, where we decode what matters before it becomes a headline. If this connected dots you hadn't seen, you know what to do. And remember, the real question isn't whether the contradictions in silver resolve. Markets always resolve contradictions. The question is whether you notice the pattern while it's still only visible in the plumbing before the resolution becomes the story everybody repeats.